The IRS accidentally built an escape hatch into the American retirement system. It opens the calendar year you turn 55. Most people discover it exists at 56. At 54, you are still in the preparation zone. The difference between those two sentences is the difference between a controlled exit and a financial emergency wearing retirement clothes. Here is what makes this particularly brutal. More than half of workers, 58%, retire earlier than they planned, usually due to unforeseen circumstances. Of those who retired early, most pointed to health-related reasons at 46%, followed by employment issues at 43%. Just 21% said they retired early because they are financially stable. The rest of them did not choose the date. The date chose them. And the date found them with the wrong account structure, the wrong withdrawal assumptions, and no bridge between where they were and where they needed to be. There is an exception buried in the IRS tax code that can save you from that scenario entirely. It is called the Rule of 55. And at 54 years old, you still have just enough time to position yourself in front of it. This video is the instruction manual. Here is what I am going to show you. The mechanical reason why 55 is a hard deadline, not a suggestion, not a rough target, and why 54 is specifically your last real year to prepare for it. I'm going to walk you through the 4 interlocking problems that every serious early retirement plan has to solve at once, because fixing only one of them is how people end up with all the pieces on the board and still lose the game. I have spent over a decade running a business, surrounded by accountants and fiscal lawyers who explained how money actually moves through the American retirement system, not how it looks in a brochure, but how it behaves in a tax return. Multiple hundreds of thousands of dollars of my own money are invested in what I'm describing. This is not theory. The central image I want you to hold on to throughout this entire video is the concept of a launch window. NASA uses this term for the specific period of time during which the geometry of the solar system lines up correctly for a given mission. Launch inside the window and you reach your destination with the fuel you allocated. Miss the window and you either wait for the next opportunity, which sometimes takes years, or you burn catastrophically more resources trying to compensate. The window does not adjust for your schedule. It does not care how ready you feel. It opens, stays open for a limited amount of time, and then it closes. The Rule of 55 is exactly this. It is a launch window coded into federal tax law, and I am going to show you exactly when it opens, when it closes, and critically, what you have to do at 54 to make sure you're actually positioned to use it when the time comes. Think of the Rule of 55 as the launch window. Every time the metaphor comes up in this video, remember that a missed launch window is not just an inconvenience. It is a complete mission redesign at fuel cost you may not be able to afford. In a few minutes, I'm going to show you the exact IRS mechanics that make this age specific and the single most common mistake that financially sophisticated people make in their early 50s that permanently shuts down access. But first, here's something that should make you uncomfortable about your own career timeline. 28% of stable, long-time employees sustain at least one damaging layoff by their employers between turning 50 and leaving work for retirement. An additional 13% of workers who start their 50s in long-held positions unexpectedly retire under conditions that suggest they were forced out. They begin by telling survey takers they plan to keep working for many years. But within a couple of years, they suddenly announce they've retired amid a substantial drop in earnings and income. Jeffrey Wenger, a senior labor economist with the Rand Corporation, says some of these people were likely laid off, but cover it up by saying they retired. There's so much social stigma around being separated from work, he said. Even people who are fired or let go will say they retired to save face. So the actual data looks like this. Take a room of 100 people who are currently 50 years old and employed full-time. By the time they reach retirement age, more than half of them will have experienced an involuntary separation, a forced retirement, or a deterioration in their conditions severe enough that leaving was the only realistic option. According to the 2025 EBRI Retirement Confidence Survey, the median expected retirement age among workers is 65. The median actual retirement age among retirees is 62. That 3-year gap has persisted for decades across multiple surveys. 3 years sounds manageable until you calculate what it costs. 3 years of lost earnings. 3 years of Social Security credits you haven't accumulated. 3 years of portfolio withdrawals you hadn't planned for, happening earlier than your model assumed. And 3 years of healthcare you now have to fund yourself at the exact age before Medicare eligibility, when individual insurance premiums are at their most expensive. These findings matter because many workers rely on the assumption that they can simply work a few extra years to make up for insufficient savings. That assumption has a failure rate approaching coin flip odds. Here is a story that captures this perfectly. There was a supply chain manager at a mid-sized manufacturing company in Ohio, let's call him Dale, who had been with his employer for 22 years. Solid performer, $300,000 in his 401k. His plan was to work until 62, then claim Social Security at 65, retire cleanly with full Medicare coverage. In 2023, his division was restructured. He survived that round. In 2024, at age 54, he was offered a package. He took it because the trajectory was obvious. Dale was 54 years old with $300,000 in savings, and he could not touch any of it without paying a 10% federal penalty on top of ordinary income tax. Not because he had done anything wrong, because he had missed the launch window by 1 calendar year. The rule requires that you leave your job in the year you are 55 or older. If you leave your job the year you turn 54, you cannot start withdrawing penalty-free money when you turn 55. The window was 1 year away, and he ran out of employment before he got there. This is the fundamental problem that nobody in the mainstream retirement conversation is addressing clearly. The decision to retire early may not be yours. The preparation to survive it, however, still is. Stay with me because this next part changes everything about how you should be thinking about your account structure right now. The Rule of 55 is an IRS provision that allows workers who leave their job for any reason to start taking penalty-free distributions from their current employer's retirement plan in or after the year they reach age. 55. Taking a distribution from a tax-qualified retirement plan, such as a 401k, prior to age 59 and a half is generally subject to a 10% early withdrawal tax penalty. The Rule of 55 eliminates that penalty, not the income tax. You still pay income tax on the withdrawal. What disappears is the additional 10% punishment for accessing your own money before the standard threshold. This rule can allow you to access retirement money without penalty up to 5.5 years earlier. If your birthday is late in the year and you separate early in the year, you turn 55 then waiting until age 59 and a half, the normal age where early withdrawal penalties get waived. 5.5 years, that is a meaningful window. For someone planning an early retirement, that is the difference between a workable bridge and a decade-long cash flow crisis. Now here is the shape of the trap, and this is what makes 54 specifically important. The Rule of 55 doesn't apply if you left your job at, say, age 53. You can't start taking distributions from your 401k and avoid the early withdrawal penalty once you reach 55. The rule is not retroactive. You cannot claim it later for a separation that happened earlier. The calendar year of separation is everything. Beyond the timing trap, there's a structural trap that catches people who have been following genuinely reasonable financial advice. The rule does not apply to individual retirement accounts. If you leave your job for any reason and you want access to the 401k withdrawal rules for age 55, you need to leave your money in the employer's plan at least until you turn 59 and a half. Once you roll that money into an IRA, you can no longer avoid the penalty. Stop and let that land for a second. Every major financial media outlet, every consolidation article, every clean up your retirement accounts piece has recommended for years that you roll old 401ks into an IRA. Fewer accounts, potentially better investment choices, more control. The advice is not wrong in isolation, but the moment you execute that rollover, you have permanently closed the Rule of 55 door for every dollar you moved. The IRA does not get this exception. Full stop. So the person who followed every piece of mainstream advice, consolidated accounts, simplified their financial life, did everything a responsible investor was supposed to do, has now accidentally built a wall between themselves and one of the most valuable withdrawal exceptions in the entire tax code. You think the problem is having enough saved. The actual problem is that your account architecture may have quietly guaranteed you cannot access what you have at the exact moment you need it most. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. There is one more layer of the trap. To take advantage of the rule of 55, your company's retirement plan must allow these early withdrawals. Some employers opt out. This is legal and relatively common, which means the first call you make, not next week, not after you finish watching this, is to your plan administrator. You ask them explicitly whether your plan allows penalty-free distributions under the rule of 55 for employees who separate in or after the calendar year they turn 55. You get that answer in writing, because your entire exit architecture may depend on that single piece of information. Now, the sequence of tax question. Any distribution under the rule of 55 would still be subject to an income tax withholding rate of 20%. That is not a penalty. It is a prepayment against your eventual tax liability. If your effective rate ends up lower than 20%, you get a refund when you file. But the timing still matters. If you separate from your employer mid-year and have already earned significant W-2 income, your total income for that year may push you into a higher bracket. The elegant move is to delay your first rule of 55 withdrawal until January 1st of the following year, when your employment income is zero and your effective rate on withdrawals drops substantially. As one certified financial planner puts it, if you were employed for most of the year and had a relatively high income, then it makes sense to not withdraw money under the rule of 55 inches to that calendar year, since it will add to your total income for the year and possibly result in you moving to a higher marginal tax bracket. At 54, you have time to engineer this properly. You have time to audit the plan, confirm eligibility, stop rolling old balances into IRAs, and start accumulating in the plan that has the launch window attached to it. So your financial advisor is sitting across from you going, I'd really recommend rolling that old 401k into an IRA. You'll have so many more investment choices. And technically he is right. He has no idea he is handing you scissors and suggesting you cut the wire attached to your escape hatch. Amused disappointment. That is the only appropriate response. Here's the part that never makes it into a retirement calculator. Knowing these numbers is one thing. Building a system around them before you run out of time is something entirely different. I had access to a lot of this data for years. It did not change anything until I organized it into a framework that showed me the sequence, what to do, in what order, with what numbers attached to each step. That is why I put together a digital book called The Exit Code. It is 8 chapters of pure research, no filler, no motivational padding, distilled from 50 years of actual retirement data into a mathematical framework for figuring out exactly when you can exit the rat race. 2 specific pieces inside this book connect directly to what we are discussing right now. The first is the 58% rule, the buffer strategy for people who recognize that the decision to retire early may not entirely be theirs to make, and who want to build a plan that survives an involuntary exit without destroying the financial architecture they built. The second is the dynamic withdrawal method that replaces the 4% trap I'm about to get to, which adjusts your draw rate based on actual market conditions, rather than assuming a static percentage works regardless of what the market is doing the year you retire. There's also a chapter on what I call the $14,000 invisible bill, the healthcare insurance gap between early retirement and Medicare that just got dramatically more expensive in 2026, for reasons I'll explain in about 60 seconds. You can get the exit code for less than a dinner out through the link in the description below. Every year you wait to build this framework, the compounding math works against you instead of for you. Now, let's get into the healthcare ambush, because it is substantially worse than most people know. Now, you're asking yourself, all right, I've got the 401k structure right. I've confirmed plan eligibility. I understand the calendar year rule. I've stopped rolling to the IRA. How do I actually live between 55 and 65 with no employer coverage and no Social Security? This is the wall that quietly executes more early retirement plans than any other single factor. You won't qualify for Medicare until 65, even if you retire early unless you have a qualifying disability. That is a non-negotiable hard stop. No amount of money changes the enrollment date. And here is the specific reason. 2026 is substantially more expensive than previous years for early retirees. Many people qualified for a subsidy to help pay ACA premiums based on household income, but the subsidies expired at the end of 2025, and the outcome of efforts in Congress to restore them is uncertain. Those enhanced subsidies had been in place since 2021. For 4 years, they softened the pre-Medicare healthcare costs dramatically for people retiring before 65. They are now gone. The cost of the gap just reset to full price. Without a subsidy, ACA marketplace premiums for a 62-year-old typically run $1,000 to $1,800 per month in 2026. Paying about $12,000 to $13,000 per year in premiums per person can consume a notable portion of annual retirement income, particularly for households relying on withdrawals from savings or investments. For a couple retiring at the same age, that number runs north of $24,000 annually in premiums alone, before any deductible, before any actual medical event, before any out-of-pocket maximum gets tested. Now think about a 10-year retirement window before Medicare. A couple retiring at 55 is looking at a potential $240,000 healthcare premium bill just to stay insured through age 65 using 2026 pricing. According to Fidelity Investments' 2025 retiree healthcare cost estimate, the average 65-year-old who retired in 2025 will spend an average of $172,500 on healthcare and medical expenses throughout retirement, not including long-term care costs. And that number starts at Medicare age. The pre-Medicare window is on top of it. This is the invisible bill. It does not appear in the default Monte Carlo run. Your advisor models portfolio growth, sets a withdrawal rate, and presents you a 20-year projection. The healthcare gap is a footnote if it appears at all. In practice, for the median early retiree, it is one of the largest single budget line items in the entire first decade of retirement. Here is the counterintuitive flip side, and this is where 54 becomes critical again. The ACA subsidy structure is based on modified adjusted gross income. If you can control your MAGI specifically by drawing from Roth accounts rather than traditional pre-tax accounts in your early retirement years, you can qualify for subsidies that dramatically reduce premiums. Roth IRA distributions do not count toward MAGI. Withdrawals from a traditional 401k or IRA do. If you have both, drawing from Roth accounts first can keep your MAGI below the thresholds that shrink or eliminate your subsidy. The difference between $55,000 and $65,000 in MAGI can be several $100s a month in premiums. That is worth the planning. The vehicle for executing this is a Roth conversion ladder. You begin at 54, when you still have 5+ years of high-income work ahead, converting a targeted amount each year from your pre-tax accounts into Roth. You pay taxes at your current marginal rate. In retirement, those converted dollars come out tax-free and are invisible to the subsidy calculation. The latter takes roughly 5 years of conversions to become meaningful. At 54, you have enough runway. At 59, you are scrambling. Only 48% of pre-retirees explicitly account for higher healthcare expenses in their retirement planning. The other 52% find out about the invisible bill the hard way. This is where I want to introduce a second thread into the story. Because the most common strategic failure I see is people treating these decisions as sequential when they need to be simultaneous. Not first I fix the account structure, then I worry about healthcare, then I think about Social Security. All of it has to be on the board at the same time. Meet Marcus. Marcus is 54, senior project manager at a tech firm that went through 2 rounds of layoffs in 2023 and 2024. His team survived both rounds. But Marcus is experienced enough to know that surviving 2 rounds in a shrinking company is not a permanently safe condition. He has done well financially. $480,000 spread across a current employer, 401k and 2 older IRAs from jobs he left in his 40s. He is planning to stay until 62, at which point he will claim Social Security early and rely on portfolio distributions for the rest. Here is Marcus's problem. In 2021, he rolled his best employer plan, the one with $400,000 in it, into an IRA. A YouTube video told him to consolidate for simplicity, better fund selection, cleaner record keeping. Everything the video said was technically accurate, But Marcus now has essentially no rule of 55 eligible money. His current employer plan holds approximately $80,000. The $400,000 sits in IRAs that explicitly do not qualify for the rule of 55. If Marcus gets pushed out at 56, which is entirely possible given his industry, his best case penalty-free access is $80,000. The remaining $400,000 is locked until 59.5, or he pays the 10%, or he navigates IRS Rule 72T, which forces him into a fixed equal payment schedule for at least 5 years. Marcus made one reasonable sounding decision at 51 that fundamentally complicated his exit architecture at 54. The decision was not catastrophic, he is not ruined, but his options are meaningfully narrower than they would have been if he had left that 401k where it was. I will come back to Marcus at the end because there is a recovery path, and it starts right now. But there is even more to this. Because even if you execute every mechanical step correctly, right account structure, right healthcare bridge, confirmed rule of 55 eligibility, there is still a variable you cannot control that can destroy a well-built retirement plan inside of 3 bad market years. And it specifically targets early retirees more than any other group. The concept is sequence of returns risk. The danger that the order in which an investor experiences market gains and losses, not the average return itself, will determine whether their portfolio survives a multi-decade retirement. The same string of annual returns, rearranged in a different order, can mean a comfortable 30-year retirement or financial ruin by year 18. The reason this risk is invisible during your working years and devastating in retirement comes down to one fact. During accumulation, the order of returns does not matter. During decumulation, the order is everything. Research by Wade Pfau estimates that approximately 77% of a portfolio's final retirement outcome can be explained by the returns of just the first 10 years. Not 30 years, the first 10. If the bear market comes in year 2 of your retirement rather than year 22, the damage is not recoverable by the same mechanism that would save a still accumulating investor. Sequence of returns risk refers to the danger that poor market returns in the early years of retirement can permanently damage your portfolio. Once withdrawals begin, losses hurt more because you're selling assets at lower prices and have less capital left to recover when markets rebound. Look at the historical evidence. The retiree who retired in the year 2000 faced what may be the modern era's harshest sequence. The dot-com crash followed almost immediately by the 2008 financial crisis. 2 devastating bear markets within 9 years of retirement created a lost decade in which a 4% inflation-adjusted withdrawal strategy left the retiree with roughly 60% less wealth by 2010 than the same strategy delivered to the 1990 retiree. And this connects directly to a problem with the framework most people use for withdrawal planning. The so-called safe withdrawal rate declined to 3.7% in 2025, from 4% in 2024 due to long-term assumptions in the financial markets, according to Morningstar research. The 4% rule itself, created by Bill Bengen in 1994 based on historical data from 1926 onward, was always a model with assumptions. 4 major factors undermine the 4% rule's safety for early retirees. The Trinity study tested 30-year periods. Someone retiring at 35 to 40 needs their portfolio to last 50 to 60 years. Each additional decade dramatically reduces success rates. Someone retiring at 55 has a 40-year horizon. The math is materially different. The 4% rule, by the way, was not handed down on stone tablets. Bill Bengen published it in 1994 based on data going back to 1926. Bengen himself has since revised the figure upward, most recently suggesting 4.7% as the worst-case historical safe withdrawal rate. He told CNBC in 2025 that retirees who stick with just 4% are likely cheating themselves a little bit of the retirement they earned. Meanwhile, Morningstar came back in 2024 and said, actually, we're at 3.7%. The original researcher and the primary research firm actively disagree with each other by a full percentage point on a number that millions of retirement plans are quietly built around. Your financial advisor probably still presents the 4% rule like it is physics. It is not physics. It is a model with assumptions, and several of those assumptions have aged poorly for early retirees with long horizons. The solution to sequence risk is not panic, it is structure. A cash buffer, 1 to 2 years of living expenses held outside the equity portfolio, means you are not a forced seller during the first 3 years of a down market. You draw from the buffer. The portfolio sits. When the market recovers, you replenish. This is the bucket strategy, and it is not exotic. What it requires is capital and discipline, and both are significantly more accessible at 54 than they are at 57 when you are scrambling from an unexpected exit. Now, the catch-up sprint, which almost no one maximizes correctly, the catch-up contribution limit for employees age 50 and over who participate in most 401k plans is increased to $8,000 in 2026. Therefore, participants who are 50 and older can generally contribute up to $32,500 each year. That is meaningful. But what almost no one is talking about, under Secure 2.0, beginning in 2025, individuals ages 60 to 63 are eligible for increased catch-up contributions in their retirement plans. This applies to 401k, 403b, and governmental 457b plans that currently offer catch-up contributions. For 2026, this higher catch-up contribution limit remains $11,250 instead of the $8,000 noted above. At age 60 through 63, you can contribute $24,500 in standard deferrals plus $11,250 in super catch-up contributions, a total of $35,750 into your 401k in a single year. And then at 64, the super catch-up disappears. You revert to the standard catch-up. Once participants turn 64, they revert to the standard age 50 plus catch-up contribution limit. This creates a very specific 4-year sprint window, ages 60, 61, 62, and 63, that no other window in the tax code replicates. If you are not employed and contributing during those years, those contribution slots are gone permanently. You cannot backfill them. The window closes and it does not reopen. If you are 54 today, you have a straight 6-year path to the beginning of that sprint. The question is whether you will still be employed and in a contributing position when the window opens. Given that more than half of workers experience an involuntary separation somewhere in their 50s, the sprint window is genuinely at risk for many people who assume they will simply be employed and contributing through 63. Here is the kicker that ties everything together. The super catch-up window and the rule of 55 are in direct tension. The rule of 55 requires you to leave your employer. The super catch-up requires you to stay. They cannot both be optimal simultaneously. The art of the early retirement decision at 54 is understanding which one you are actually going to be able to execute the plan where you leave at 55 and use the penalty-free access, or the plan where you stay through 63 and maximize the sprint window. Most people drift between both without committing to either, which is how you end up executing neither cleanly. Let me give you a specific scenario with real numbers to make the trade-offs visible. You are 54, married, filing jointly, household income of $200,000. You have $400,000 in your current employer's 401k confirmed rule of 55 eligible and $120,000 in a Roth IRA. Your spouse has $200,000 in their employer plan and $60,000 in Roth accounts. Step 1. Both of you confirm plan eligibility for Rule of 55 in writing from your administrators. You stop all automatic rollovers into IRAs. Every new dollar of contribution stays in the employer plan. Step 2. You max contributions for 2 years, your remaining time, before the potential exit. In 2026, that is $24,500 each in standard deferrals, plus $8,000 each in catch-up contributions. Combined, you are directing $65,000 into tax advantage space this calendar year alone, plus whatever employer match applies. 2 years of this at maximum adds $130,000 to your pre-tax portfolio, compounding from the day it goes in. Step 3, begin a targeted Roth conversion schedule. You convert $40,000 to $50,000 per year from your traditional accounts into Roth, paying taxes at your current marginal rate, the highest rate you will likely ever face in your life, because in retirement your income drops dramatically. The math of paying taxes now at a known rate versus paying taxes later at an unknown rate, with the converted dollars growing tax-free in between, favors conversion for most people in high-income years. Step 4. At 55, if the employer plan allows it, you leave your job early in the calendar year. You do not touch the 401k immediately. You live on Roth distributions and taxable accounts through year 1, keeping your MAGI low enough to qualify for ACA healthcare subsidies, which become critically important given that the enhanced subsidies are now gone. Step 5. You delay Social Security for both spouses to age 70. You fund the gap from 55 to 70 using the bucket strategy. Rule of 55 distributions as needed. Roth draws for income managed years. Taxable brokerage for flexibility. Waiting beyond full retirement age increases your benefit by about 8% per year until age 70. Delaying until age 70 can increase your monthly Social Security payments by up to 24% compared to claiming at full retirement age. The difference in 2026 between the maximum benefit for someone who retires early at 62 versus waiting until 70 is $2,212 per month. Over a 25-year retirement, that difference in monthly income compounds into a number that dwarfs almost any other single financial decision you will make in this decade. The bridge is the architecture. The launch window is the mechanism. 54 is the year you build both. Here is a thing your financial advisor is probably not explaining to you about any of this. And I say this with amused disappointment rather than conspiracy theory. The structure of the advisory industry does not reward this kind of granular work. The standard model is assets under management, 1% of the portfolio, billed quarterly. For an advisor, having your money consolidated in accounts they manage is a good outcome. Rolling your employer plan into an IRA they manage is cleaner for them than leaving it scattered across plans they don't touch. Their incentive is aligned with consolidation. The rule of 55 is aligned with non-consolidation, specifically with leaving money in your employer's plan where they have no management relationship. Those two things are structurally in conflict. I am not saying advisors are dishonest. I am saying that when a system's incentives push a certain direction, that direction gets reinforced in advice even when the client's situation calls for something different. Only 17% of large employers offer retiree health benefits, according to Mercer Health and Benefits. The rest of the healthcare gap planning falls to you. The rule of 55 planning falls to you. The Social Security bridge falls to you. The only correction available is knowing the rules at the level of detail that lets you audit your own situation. Let me close the Marcus loop, because his situation is recoverable and the recovery path starts right now. Marcus is 54. He cannot undo the IRA rollover. That money has gone into the IRA, and the IRS does not offer retroactive exceptions. But he can stop contributing to the IRA going forward. He can direct every new contribution into his current employer's 401k. Over the next 2 years, at maximum catch-up rates, he adds approximately $65,000 to the plan. His rule of 55 eligible balance goes from $80,000 to roughly $145,000. Not $400,000, but enough to bridge 2 years of retirement expenses without touching the IRA or triggering a penalty, if he manages his budget discipline. He also begins Roth conversions on the old IRA money, moving $40,000 per year into Roth over the next several years, paying taxes at his current marginal rate. The remaining $200,000 in the IRA waits until 59 and a half. But by then, the Roth ladder and the rule of 55 money give him a workable arc. He is not where he would be if he had never done the rollover, but he is not in freefall. He made a course correction at 54 when the runway was still long enough to matter. That is the entire point of this video. Let me bring this home. The percentage of people retiring between 50 and 54 has declined from 9% to 6%, and the rate of people retiring between 55 and 59 has dropped from 19 to 11% over the past 2 decades. Early retirement, the intentional kind, has been getting rarer even as its financial mechanics have been quietly improving. The tools exist, The tax code provisions exist. The catch-up windows and Roth conversion strategies and sequence risk mitigation frameworks, all of it exists. The bottleneck is not the instruments. The bottleneck is knowing what they are, knowing how they interact, and starting early enough for the positioning to actually work. 3 takeaways. Specific ones, calibrated exactly to what you are facing at 54. Takeaway 1, call your plan administrator this week, not next month, and confirm in writing whether your current employer's 401k allows penalty-free distributions under the Rule of 55 for employees who separate in or after the calendar year they turn 55. If it does, stop all automatic IRA rollovers immediately. Every dollar you send to an IRA from this point forward is a dollar that loses Rule of 55 eligibility permanently. This is a one phone call decision with irreversible consequences. Either way, make the call. Takeaway 2, start a Roth conversion schedule now and build it around your MAGI ceiling. Calculate what your modified adjusted gross income will look like in retirement. Identify the threshold below which you qualify for ACA Marketplace subsidies, roughly $62,600 for a single filer in 2026 at the 400% federal poverty level mark. And design your Roth ladder to give you the option of staying below that threshold in the critical pre-Medicare years. The ladder takes 5 to 7 years to become meaningfully useful. At 54, you are right at the boundary of building one that works. At 59, you are managing consequences. Takeaway 3, build the bridge on paper before you need it in real life. Map out a year-by-year income plan for the 15-year window between a potential 55 exit and a 70-year-old Social Security claim. What accounts fund which years? What is your MAGI in each year? And does it fall below the healthcare subsidy thresholds? Where does your cash buffer come from during a down market in year 1 through 3? What happens to the plan if the market drops 30% in year 2? These are not existential questions. They are math problems with specific answers. And they are far more tractable at 54 when you have income and options than at 57 when you have neither. Lazy investing built more fortune than crypto memes. The laziest, most boring version of all of this is one phone call, one conversation with a tax professional about conversion amounts, and one spreadsheet with 15 rows. The alternative is discovering the Rule of 55 exists at 56 when it is too late to use it, and spending the next 4 years paying penalties on your own money while you wait for the 59.5 clock to run out. The window is open, the geometry is right, you know what to do.